All right, let's get into our Financial 15, and we're going to talk about inherited IRAs and how you might be able to save tax on an inherited IRA. So I'm just pulling up my whiteboard here. Okay, I think that's good. Okay. All right, so this is our Financial 15 section. This is the last 15 minutes or so. I'll just make this a little larger so you can see it, of our weekly webinar. And what you just missed, if you're just tuning in on YouTube, is about 25 minutes of market updates and Ed Slot updates from the Ed Slot group. There are timely updates with IRA distribution issues, and we talked about inherited IRAs there as well, and the new changes to the RMD rules and the waiver for certain RMDs for this year, not all RMDs, but waiver of certain RMDs for this year. And some other items. So if you want to go back and see that, and if you're just joining us for the Financial 15, you want to find that weekly webinar, you can do that. Find that on our website, attleborowealth.com. And I have that here. Watch this. All right. So attleborowealth.com. It's up here in this corner. But you can go there and you can look under the education page. And you'll find our weekly webinars, our special webinars, and the slot corner. And I'm going to share where you can find the slot corner in a second. But today we're going to talk about, in this Financial 15, we're going to talk about how to save tax on inherited IRAs. So folks, this is a common issue. I've run into it a lot lately, but I do run into it often throughout the year. So inherited IRAs are difficult because you cannot convert an inherited IRA to a Roth IRA. So not only are there complex distribution rules like you just heard with the updates from the slot group, and there's certain years, we going back to 2021 with this, and 2020 with the Secure Act, we have different calculations coming out of 2020 and 2021 and 2022, and now updates to the Secure 2.0 and how that applies to folks in pre-2020. It's very, very confusing. But from a tax planning point of view, whenever we have our three buckets, and I'm mapping out for somebody, and this one's taxable, tax deferred, and tax efficient or tax free. Whenever I have an inherited IRA in here and I list, $1 million, for example, in an inherited IRA, I always have to put an asterisk by it because we talk about the fact that, well, unfortunately, you can't convert those dollars over to a Roth IRA. So it can undo years of planning. Many people come to us for tax efficient planning, general financial planning for sure, and investment management, but certainly tax efficient planning. And we show people how they can work towards or get to zero taxes in retirement and often save themselves, if not millions of dollars a year over their lifetime, hundreds of thousands of dollars a year over their lifetime for themselves and their families. But suddenly, listen, it's wonderful inheriting money from folks who care about you, but it can undo years of planning, and you're not just stuck. If you're not it's one of the things that I find interesting is when I talk about this asterisk that we have on the inherited IRA, and I say you can't convert that money, so we have to figure out how else we're gonna spend that down or use it in a tax efficient manner. And many astute people who have been following the webinars and reading books, and they say, oh, I didn't realize that. I had one person who said, yeah, I think you actually can. I think you're wrong. But you can't convert it. Once you inherit it, you can't convert it. Maybe that'll change, but that's the rules now. And as I said, it can undo years of planning. So what are solutions? Well, one thing is so I'm over here, solutions. You can take advantage of qualified charitable distributions. So I did a whole webinar on June 9th about qualified charitable distributions and the rules. So if you want to learn more about what a QCD or a qualified charitable distribution is, go to that webinar and you can learn all the rules. But when we're talking about inherited IRAs, the beneficiary must be over 70 and a half. I know it's confusing because the old RMD age prior to the Secure Act used to be 70 and a half. That was changed to 72. Then under the new law, that was changed, or rules, that was changed to 73, and it's eventually going to be 75. But the IRS kept the age 70 and a half for QCDs. I promise that's the rule. It has not leapfrogged and followed this. QCDs are still 70 and a half. So beneficiaries must be over 70 and a half to do a qualified charitable distribution. So if you're inheriting from your parents and they've been doing qualified charitable distributions allow you to take money out of your IRA, send it directly to a charity, currently up to $100,000 per individual, and you don't pay tax on that. As long as it's a qualified charity and as long as it goes direct, there is no tax on that. So your parents may be doing that, but now if you inherit that money and say you're 60 years old, you cannot continue these QCDs. And if your parents were over RMD age, you have to continue RMDs. And I'm going to show you an effect of that, but you could see how it could undo years of planning because you might have your buckets balanced and you can, so just going back to a webinar about that, I did how to maximize your tax brackets, and it talks about how to balance these buckets, the ideal amount that you have in each bucket. And let's say you have your ideal amount in each one of those. And now suddenly this $1 million is spinning off, $35,000 a year. And that's increasing your modified adjusted gross income for things like IRMA calculations. That's the amount that you have to pay for Medicare. When you reach certain levels, it's the amount over the base Medicare price. It could increase, of course, your taxable income, increase your tax on Social Security, and take you right out of the zero tax bracket if you got there. So, or significantly increase your taxes. So these are things you want to pay attention to when you're doing your planning. Don't just think about your funds. Think about other people, close to you and people around you who may be sending you inheritances. So QCDs might be an option for you, but the person inheriting the funds must be 70 and a half. So I have Roth conversions on here. But Mark, you said you cannot do Roth conversions. Yes, but your parents or the folks who are leaving you the money, right? Let's just call them your parents or the folks leaving you the money. I can't think of the correct term for it, but the folks leaving you the money, they can do Roth conversions, and we're going to have a little example of that. They might be able to do a life insurance retirement plan or cash value life insurance. Now, the deeper you get into past age 70, the harder that gets. So it's good to have these conversations now. And, again, I just, so many of my topics here are based on real conversations I have with folks. And it feels like just a couple of weeks ago, I was sitting with somebody, and this exact example that I'm going to share with you right here. I rounded these numbers just to make it easier. But this was the exact example. A fellow said, my father's 87 years old and he's got $1 million or so in an IRA, and I'll be inheriting that. And I said, well, unfortunately you can't convert that money once you inherit it. And he said, I didn't know that. That kind of throws a fly in the ointment in this process. How do you deal with that? And I said, well, one way is your father, his wife is still alive too, but it's the dad's IRA. Your father can convert those funds. Now the natural progression is the IRA is going to go to the spouse, but father's 87 years old. I think his mother was 85 years old. There's going to be a transfer of that IRA probably at some point. So currently, a father owning it, the father can convert that traditional IRA to a Roth IRA before it becomes an inherited IRA. What's the benefit of that to the child? Well, the benefit is that we pay tax at more favorable tax rates. Again, these are the tax brackets we're looking at today. The tables I'm going to share with you, you can find at attleborowealth.com, and I'm actually going to pull that down and show you. This is part of the new website, so I'm excited to share this with you. But if you go to, here's the homepage. I'll just share the homepage with you. Let's see. Yeah, you're seeing that there. And if you go over to, let me move it a little bit so you can, that's not going to work here. Okay, yeah, you can see this here. So education and resources, I'm over here on the right-hand side. You drop that down and you go to the slot corner. And you just page down. There's a lot of information about the slot group and what's good, so great about the slot group. But you can download these charts right here. You click on here, access your free downloads. I promise there's no charge. But two of them this one here, the Uniform Lifetime Tables, and the orange one that just passed, we're going to be referring to today. But you can view these on your own and use them at your convenience and for your reference. There's the orange one. So now you're going to see that orange one right here. So we want to take advantage of these tax rates that we have today. These are the 2023 tax rates because we know that in the future, these taxes are going to be significantly higher, if not double. And our studies show that the average middle-class American is going to be in the 40 to 45% effective tax rate, probably by about the year 2030. So if that's the case, doesn't it make sense to consider paying taxes at a lower rate now for yourself and potentially for your parents? So it may make sense for your parents to, if they're concerned about their own situation and potentially what they're leaving you, then it may make sense for them to consider that Roth conversion. It's a really easy way to step in front of that issue of, oh, geez, I might certainly probably, within the next 10 years, potentially, I'm going to inherit this IRA. I've done all this tax planning work to minimize my tax exposure. I've been paying, the tax rates at 22 and 24%, or maybe even 32%, but probably 22, 24% now to avoid these higher taxes. And then I inherit this money, which is great. But now I have to pay higher taxes on required minimum distributions, and I have to deplete it all within 10 years. By the end of that 10 years and take those distributions, and it's going to just kind of snowball on you. But all that goes away if that inherited IRA is in a Roth. You still have RMDs. You still have, there's no RMDs in a Roth IRA. Even an inherited IRA still has to be depleted by the end of that 10th year, but it doesn't, there's no tax. So even if you withdraw a certain amount every year out of the inherited Roth IRA, there's no tax on that, and it's not going to affect your tax plan. I hope that makes sense. But what you want to do, I laid out here what the situation was with the father. Again, he's 87 years old. This is important. The spouse is still alive, I wrote, because remember, people forget this all the time too. Look at the difference in the marginal tax rates for income for married filing jointly and for single. I know you've heard me say this probably 150 times, but your taxes basically double as soon as one of you passes away. And people don't consider that either. That's suddenly single. You're chugging along through life. You're both retired. One of you is going to go before the other. And there are a lot of effects negatively. And one of them is your income gets taxed at a higher level much sooner. You can see the comparison here. Let me erase this to make it a little easier to see. But you can see the comparison here. Where's my marker? To achieve the top of the 22% tax bracket, if you find yourself, if that's where you find yourself, the 22% tax bracket, you have all the way up to $190,000 in taxable income as a married filing joint filer. A single filer only goes up to $95,000. So you lose just about $100,000 of optimized income is from a tax point of view, because that $100,000 now lives in the 24% bracket, and it continues, right? So the top of the 24% bracket for a married filer is $364,000. You can see here that it's only $182,100. That's half for a single filer. So once mom in this example passes away, dad's going to have a harder time converting this $1 million. So it's good to have this conversation with your parents or whomever is potentially passing that money to you now to make it, to give them more time. Now, if mom was not alive, it could still be done. It's just going to take longer because look at this. We're working with a taxable income of $86,000. Now, understanding that the tax rates here, and let me just draw it out maybe a little clearer for you. We go from 10 to 12 to 22 to 24 to 32, 35, and can't forget 37. So dad's current, what I just say, he was 86,000. So let's find that together. He's still in a 12% tax bracket. So he could just fill in another $3,000 and convert that and stay within 12. Well, that's a smart move, but he might want to consider if it's helping out him potentially and helping out his son to move into the 22% bracket to convert, maybe $100,000 of that money, or maybe even take it all the way up to 190,000. So that would leave him about, what did I say, 68,000 or 86,000. So that would leave him, just about 100,000 that he could convert to go all the way up to the 190,000, the top of that 190,000. So even with, $1 million, and if he has to convert the entire thing, 100,000 a year, simple math is that'll take him 10 years, but you have to factor in growth. So that'll take even longer. Dad's 87 years old. Don't know if he's going to be here that long. So it may make sense to go, to the top of the 24 and go all the way to 364,000. And even though that may not be the best answer for dad in the tax bracket, if you discover that dad is unlikely to need that money, it's going to end up going to you, then it might make sense to push into the higher tax bracket. But that all has to be determined with financial planning and whatnot. But it's good to have that conversation. I know it can be a difficult conversation. Listen, my mother passed away when she was 90 years old. But when she moved up several years before that from Florida, I hope I wasn't cutting you guys off with that. But when she moved up from Florida, we had to have a real conversation about her finances. The rules are different in Pennsylvania than Florida about children's responsibility for their parents. So that was an important conversation to have. If you're going through all this hard work and you're trying to get this tax efficient scenario to work for you, then you don't want something in the background that's going to potentially blow this all up if there's a potential for it to be fixed. Now, if you go to your parents and they say, listen, I'm just not interested, and you can share this video with them, you can have a conversation, you can get me on a conference call with them, that's fine. Bring them into the office, whatever works for you, and they still don't go for it, then you've done everything you could do for them, for their benefit, and certainly for your benefit, and maybe even your siblings. I don't know how this $1 million is going to be split up, but I hope that's helpful. That is one way, or a couple different ways, to handle inherited IRAs and to potentially save yourself a large amount of money in taxes. Now, if you have questions, you can look at that. You can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. If you would like to schedule time with us, you can do so on our website at attleborowealth.com, or just send us an email at questions@attleborowealth.com. I hope that was helpful. It's now 10:45. We're going to end our broadcast for today. You're going to receive this video via recording. If you have any specific questions, please reach out to me via email, as I said, at questions@attleborowealth.com. Otherwise, enjoy the rest of your week, and we'll see you next week. Take care.